in our opinion, I don't think it really matters in the grand scheme of things if they start with 50 or they go 25. We think they need to front load as many rate cuts as they possibly can between now and let's call it end of Q1 of next year, because ultimately, according to our forecast, by the time we get into the second quarter of next year, it'll be pretty clear to the general investor consensus that inflation is not going to return durably to the Fed's 2% target. And maybe we have the view at 42 Macro that they don't even want that. They're telling us they want that. But ultimately, what they really want is a soft landing in the economy. And in order to get a soft landing in the economy, you have to run and operate the economy with a higher level of structural inflation. And we think that's a part and parcel to our J wants a soft landing thing. With respect to the terminal level of the policy rate, but ultimately, if you take a step back again, go back to the 30,000 foot view, the Fed is lowering the policy rate into a business cycle expansion, and growth is likely to surprise to the upside. So when you say all those things, in succession, you realize that it's a generally supportive backdrop for asset markets.
All right, welcome back to another episode of Forward Guidance. And joining me today is the legend himself, Darius Dale of 42 Macro. What's going on, man?
Felix, I appreciate the kind introduction, man. Thanks for having me here. I wouldn't say I'm a legend, but I guess I'm pretty good at my job.
That's an understatement, but there's nobody I'd be rather talking about today. We're recording today on Tuesday, 11 a.m. Pacific. We're about 24 hours exactly from the big FOMC meeting that's happening tomorrow. It's looking like it's going to be the first cut of what will likely be a rate cutting cycle. So I just want to get right into it and ask you, what are you looking at as we head into tomorrow?
I think that you have to start the conversation with like a 30,000 foot view on actually what is happening in the economy, because I think that'll help better contextualize what asset markets are likely to do in response, not just to tomorrow's policy rate normalization, the start of the policy rate normalization, but also throughout this policy rate normalization cycle. So number one, with respect to growth, we've been the high on the street on growth for 2 years now. Consistent with our resilient U.S. economy theme, which we authored, a little bit over 2 years ago. I believe that we were on this program kind of in the early innings of that. Space is calling for U.S. growth that could persistently and consistently surprise to the upside. That view, we maintain that view. That view is persistent. So we are expecting growth to continue generally and persistently surprising consensus expectations to the upside, which ultimately means the Fed is easing monetary policy into a late cycle expansion. Now, that's got a couple of implications as it relates to inflation and ultimately for asset markets. But with respect to inflation, we have a view that we're getting closer and closer to the bottom of the inflation sine curve, and that by certain more than likely by the sort of second quarter of next year, to be pretty clear to investors that inflation is not going to return durably to trend in the absence of a recession. I don't believe the Fed wants a recession. We don't think the J. Powell Fed wants a recession. So ultimately, we're talking about an environment where nominal GDP is probably going to be persistently higher than the consensus expectations over the next, let's call it calendar year or so, which ultimately means the Fed needs to front load as many rate cuts earlier in this process to sufficiently extend the duration of the business cycle. And if they do that, then we're talking about an environment where risk assets, stocks, crypto, credit, should outperform defensive assets like the dollar and bonds. So that's been our view. We maintain that view. And ultimately, we think tomorrow's rate cut, whether it be 50 basis points, 25 basis points, is more or less supportive of all those views. So we can unpack any of that in whatever order you like.
Yeah, that's some great context. I feel like one of the main quarrels that the market is having these days is this debate between, are we cutting rates because we're about to enter a recession, or are we cutting rates because of it's a normalization process and this battle for inflation is somewhat complete, and that the risks have transferred over to the labor market, so we're going to become less restrictive. And it feels like that's sort of the debate at hand. So it sounds like from your perspective that you believe that secularly, inflation is bottoming out here and will trend higher. So, I imagine that means that you're more so in the normalization camp than the, we're about to enter a recession camp. Is that correct?
Very much so. And I actually got a good question on Twitter about this today with respect to normalization, because the customer or the client was saying, hey, man, that's a big word. You don't need to use big words like that. But the reality is, I think it's important to make the distinction between policy normalization and outright easing. Outright easing means the Fed is intending to take the policy rate below neutral setting, such that it would create stimulus in the real economy. Normalization means that they intend to take the policy rate to neutral. They don't want to create easing in the economy. They just want to recalibrate the degree of restrictiveness such that it declines over time and sort of settles out at whatever the Fed believes is neutral from the perspective of the Fed funds rate. The latest dot plot projection, which are admittedly stale coming from June, calls for a neutral rate of around 2.75%. We've been of the view that the neutral rate throughout this business cycle was much higher than the prior estimates. It was coming up from 2. We've been of the view that it's been much higher than the prior estimates. I don't think anyone knows, and we certainly don't know exactly what the appropriate level of the neutral policy rate is, but it's certainly not 5.5, and it's certainly not 2.75. So the Fed's going to continue to sort of feel around in the dark to try to figure out exactly where that is. But ultimately, if you take a step back again, go back to the 30,000 foot view, the Fed is lowering the policy rate into a business cycle expansion, and growth is likely to surprise to the upside. So when you say all those things in succession, you realize that it's a generally supportive backdrop for asset markets. And generally speaking, taking us back to the first principles, if you want to see a trending risk-off market regime, which I think a lot of investors are sort of nervously anticipating, and appropriately so, we've had some volatility in recent months, and obviously the data has been somewhat mixed in recent months as well. If you're going to anticipate a trending risk-off market regime and invest as an investor, you need to experience one of 3 or some combination of these following 3 things. You need to have a sharp, protracted, and unexpected deceleration in growth. You need to have a sharp, protracted, and unexpected acceleration in inflation, and/or you need to have a sharp, protracted, and unexpected tightening in monetary and/or fiscal policy, usually both. And when we look out on the horizon, it's very unlikely we see any of those 3 things materialize, certainly on a trending basis, for the next at least couple of quarters. So, we have a relatively sanguine take on asset markets.
Nice. Yeah. So it feels like there's 2 debates at hand. There's the first one, which is quite a unique moment, is that we're going into the meeting tomorrow where we don't really know how much they're going to cut. There's debate around 25. There's debate around 50. Right now, the implied probabilities are leaning towards 50.
Slightly.
If they're going to go 50, is that still a normalization cut? And why is there even that debate right now about the number? And then the second question is more about just that terminal funds rate and leading into what you're talking about around neutral rate, which is the path and where do we bottom out on this cutting cycle. So would love to just hear that first component of 25 versus 50 and why there's uncertainty, and then looking at terminal funds and where that nets out.
Oh, great question, Felix. I appreciate that. So I'll start with 25 versus 50. We'll unpack our, just kind of general thoughts on that through the lens of our most recent macro scouting report here. We publish this presentation every month to our clients here at 42 Macro. So with respect to the 25 versus 50 debate, we know that the U.S. economy is late cycle, as evidenced by the inversion of the 3-month 10-year Treasury yield curve. We know the U.S. economy is late cycle, as evidenced by just a low level of the unemployment rate. We backed up in the unemployment rate terms for the past, let's call it a year plus. However, we're still at 4.2%, which, as you can see, just by this horizontal line that I just drew across the page, is essentially in the bottom 5th percentile of all historical observations. So we understand that the economy is late cycle. So investors, there is a cohort of investors that is nervously concerned about a recession, and have been for quite a while, right? That's been kind of a general underlying theme of asset markets throughout the duration of our resilient U.S. economy theme, is that investors one by one have been forced by the markets to capitulate on the recession view. We expect them to continue to capitulate on the recession view. So this is the 50 versus 25 debate. In our opinion, I don't think it really matters in the grand scheme of things if they start with 50 or they go 25. To me, what matters more, and we'll talk about this when we get to the inflation part of the debate, is we think they need to front load as many rate cuts as they possibly can between now, let's call it end of Q1 of next year, because ultimately, according to our forecast, by the time we get into the second quarter of next year, it'll be pretty clear to the general investor consensus that inflation is not going to return durably to the Fed's 2% target. And maybe we have the view at 42 Macro that they don't even want that. They're telling us they want that, but ultimately what they really want is a soft landing in the economy. And in order to get a soft landing in the economy, you have to run and operate the economy with a higher level of structural inflation. And we think that's part and parcel to our J wants a soft landing thing. With respect to the terminal level of the policy rate, so if you go back and you look at what markets are pricing in relative to what the Fed is pricing in, markets and the Fed are, for the first time in a long time, basically right on the same level. So if you look at what markets are, so if you look at the overnight index swap market, so these are U.S. dollar money markets, these are, it swaps on the Fed funds rate itself. If you look at the the minimum value on the YS curve out 5 years relative to the longer run median dot plot estimate, those are essentially identical levels. Both the markets and the Fed are essentially calling for the same kind of 2.75% level of the neutral policy rate. That's what they're both essentially guiding to relative to the June dot plot. The difference between the market and the Fed is the speed that the policymaker is likely to take to get there. So if you look at what's priced into the Fed funds futures curve between now and year-end 2024, there are 4 rate cuts priced in between now and year-end 2024 versus only 1 for the latest dot plot. That's going to change obviously tomorrow. If you look at what's priced in between now and year-end 2025, there are 10 rate cuts priced in between now and year-end 2025 versus only 5 by the Fed, at least according to the latest dot plot. And then the markets are sort of essentially saying they're going to kind of stop there by the end of 2025. So the markets are essentially saying the Fed is going to normalize policy and get to a neutral level of the policy rate by year end 2025. However, the Fed sees that process taking a couple of extra years, over the course of 2026 and into 2027 to get to the neutral policy rate. We've been of the view that the Fed needs to essentially do exactly what the market is pricing in, which is normalize policy as quickly as you possibly can, because ultimately, if you don't normalize policy as quickly as you possibly can, you might not have the political cover from an inflation reporting standpoint to do so until you're getting into 2026. And then in my opinion, that could be too late as it relates to, kind of stick saving the business cycle.
Yeah. What I find interesting about this is when people hear, there's 10 rate cuts priced in, the bond market's pricing recession, but it sounds like it's more so pricing towards what, there's difference of debate around where is neutral, but it's their attempt at neutral is we're just going there. We're not necessarily going into an easing cycle. So it sounds like we're not actually priced for a recession in the bond market, are we?
No, not at all. No, if you look at what's priced into the neutral level of the policy rate in money market, U.S. dollar money markets, it's only pricing in about half of a recession, more or less. So if you look at recessions, so recessions that have in a median basis in post-war U.S. recessions, the Fed has lowered the policy rate by around 400 basis points. On the median basis in recessions that are caused by the tightening of overly restrictive monetary policy, the Fed has lowered the policy rate by a median of 475 basis points. And so this sort of 200-ish, 50-ish, 10 rate cuts, that's right around 55% of a recession. So the markets aren't necessarily pricing in a recession. So we would disagree with the view that the bond market is pricing in a recession. We agree with the view that the bond market is pricing in sort of a bimodal distribution. One side is soft landing, which we're currently in that camp, and the other side is recession, which I think some cohort of investor consensus is still in that camp. And as a function of that cohort of investor consensus still being in that camp, we think the maximum amount of market risk at the current juncture that investors should probably be positioning for with a 6 to 12 month investment horizon should be for the area under the recession camp to decline over time and the area under the soft landing camp to increase over time as investors get more and more confident about the durability of the business cycle, and the Fed ultimately gets more and more confident about the labor market. And ultimately, on the tail end of that, after those two things occur, investors and the Fed will start to get less and less confident about the sustainability of the progress that we've seen on inflation. And so ultimately, we still think from a market signaling standpoint, we would say we're probably later innings in the rally in bonds. We still have a ways to go in terms of the rally in stocks and credit and crypto and broader risk assets. We were appropriately, we helped our clients appropriately position and take down risk into the correction in stocks and crypto starting in late June. We helped clients appropriately take up risk to the bond rally starting in early June. And ultimately, we think, if I can predict the predictors, because we use systematic tools to guide our client asset allocations, if I can predict those predictors, I would imagine those systematic tools will be sort of, arguing this process over the next 6 to 12 months.
Okay, so let's unpack this nuance that you keep mentioning about front loading the rate cuts, basically to get ahead of it while there's political cover to cut. If you're mentioning how I believe you have this thesis that inflation has bottomed out and will start to pick back up in the first half of next year, if so, what is actually the reason to cut rates now if that's the belief, and why do you feel this? It's interesting nuance that you believe they will front load the rate cuts, but it sounds like that might also be a mistake when we look at it from a year from now. Is that how you characterize it?
It would be a mistake if the Fed actually wanted 2% inflation. But again, we don't believe and have not believed for years that the Fed wants 2% inflation. So consistent with our sticky inflation theme and our forward turning analysis, regime analysis, is that this is a Federal Reserve that is implementing the typical forward turning playbook. Historically speaking, what we've seen in forward turnings from the Fed is a tremendous amount of currency debasement and financial repression in order to help the fiscal authority sort of capitalize a fiscally dominant regime. And so we believe that is the current setup. And as long as that is the current setup, then the Fed is essentially talking out of both sides of its mouth. It wants 2% inflation, but it also wants a soft landing. Well, I'll show you a chart that shows never in the history of the U.S. economy have we gotten both of those things. You have to choose. It's one or the other. So if you kind of look at the history of inflation, when you study the post-war U.S. business cycles, which are probably most relevant, I think anything prior to that is probably the economies evolved so differently that I think that data is probably less relevant. So just isolating the 12 business cycles that we've had in the post-war U.S. economy, we understand that inflation is the most lagging indicator of the business cycle and is unlikely to return durably to trend absent a recession. And how do we determine that determination? So when the chart on the left shows the median trailing 10-year delta adjusted z-score in months before and after recession, with 0 being the recession. And what each of these plots represents is how the median sort of path that each of these indicators or cycles has taken in and around a recession, late in the business cycle, and then obviously into the early part of a recession. And so how the business cycle works, this is the empirical study of how the business cycle actually works, as opposed to economic babble that we all learned in school. So what we know is that policy gets restrictive. Let's call it around 5 to 6 quarters ahead of a recession. Then corporate profits break down that right around a year ahead of a recession. Then liquidity breaks down right around 3 quarters ahead of a recession. Then growth in stocks break down right around 2 quarters ahead of a recession. Employment breaks down, which the NBR obviously uses to date the business cycle, breaks down right on time when the recession starts. Credit breaks down or breaks out because it's all delta adjusted. So things like charge-offs and delinquencies, all those things break out durably above trend. Let's call it 1 quarter after recession starts. And then inflation being the most lagging indicator of all these business cycles that formulate the business cycle, that inflation breaks down 4 to 5 quarters after a recession. You can kind of see it a little bit clearer on this chart where we just show growth versus headline and core inflation. Growth, again, breaking down durably below trend, 2 quarters ahead of a recession. Inflation breaking down durably below trend 4 to 5 quarters after a recession starts. And so it's our view that, okay, and more importantly, when you unpack the 12 different business cycles, the entire, review each of the data points in the sample across those 12 business cycles, there's no evidence of inflation breaking down durably below trend absent recession. Every single one of those 12 observations has inflation above trend ahead when the recession starts. And so these investors need to realize that, when you look at some of the expectations amongst Wall Street investor consensus, what we show the red line here in this chart on the inflation time series, the Wall Street investor consensus is calling for inflation, just like the Fed, to continue meandering lower and lower and lower and lower perfectly with no uptick. And that would be historically inconsistent with how the inflation process actually works. Now, this time may be different. If this time is different, we're going to be wrong on this view. But if this time is not different and inflation does exactly what is historically done, it's probably going to bottom at a level and start to recycle higher again. And that's exactly what I think we're starting to see if you look at some of the leading indicators of inflation. So you look at core PPI, that's the blue line in this chart. The red line in this chart is core CPI, and the black line in this chart is the core PC deflator. Core PPI bottomed at around 2%. Historically, core PPI used to bottom at around 0% and cycle up to, let's call it, 2.5%, 3%. And that's how you created a mean of 1.5% to 2% of inflation, on a trailing look back. Well, now if we bottom at 2% and start to reaccelerate higher from there, which it's, we're 6-9 months into this process, then we're very likely to see the same outcome occur when you in the black line and the red line, which are core PC and core CPI. And so if these things all start to bottom at levels that are historically inconsistent with 2%, much like the blue line already has, that would be obviously supportive of our view. That would be confirmation of our view, rather. And the one thing that I think is supportive of the view is shelter inflation. So we're going back to April of this year, we made the call that we were probably going to, going back to first quarter this year, remember we had the big backup in inflation that caused the repricing of the rate cut in the bond market. In April of this year, we said, hey, we're actually on the precipice of a sharp disinflation in observed and reported home price inflation vis-a-vis shelter CPI and housing PCE. And so if you look at FIFA home prices and Case-Shiller home prices, we had this significant slowdown in the 3-month annualized rates of change, that's the blue bars, in observed home price appreciation 2 years ago. And so we use that, and we accurately made the call that we would see a pretty significant deceleration in shelter CPI and housing PCE, and that would cause core inflation to break down in a way that would allow the Fed to have more confidence in starting to normalize monetary policy. So check on all that. But now we're kind of getting towards the end of that process. And if you look forward, let's call it 6 to 9 months ahead, we're kind of getting to a place where we should see a kind of echo of shelter and home price of home price appreciation that could cause shelter inflation, at the bare minimum reported shelter inflation, to stay sticky. So in our view, we think our views on inflation are obviously wildly divergent from consensus, and we have a moderate degree of confidence in those views. Where we have the maximum amount of confidence is where we've had the most confidence for the last couple of years, is in the economy is likely to remain resilient, and the Fed is likely to, or is wants to engineer a soft landing in the economy.
Based on everything you just mentioned, it sounds like, a lot of people are worried that the Fed and Jerome Powell are late to the show. They should have already been cutting for a while now. Based on everything you just said, it feels like they're not necessarily late. They're arguably just about on time. The recessionista argument would look to dynamics that are happening in the labor market, and then looking at how unemployment rate is it's quite a trending indicator. Once it goes, it really continues, and that it's a lagging indicator. So the fact that it's already trending upwards means we think we're too late. That's the recessionist argument. What's your thoughts on that argument?
Very much disagree with that argument. So a lot of and again, that's what makes a market. I'm not here to poo-poo anybody's views or their research process or whatever. We're just here to report what we think is the most appropriate solution, so we can get our clients into the right asset allocation, Felix. And so going back to this on with respect to growth, when we look at things like aggregate income, or we look at the growth of the labor supply as creating a positive supply side dynamic in the labor market, and ultimately the labor hoarding that we continue to see in the labor market, we just think that the recessionista views on the labor market are just off base. They're not really being supported by data, in our opinion. And again, that might be a loaded statement for some people who are on the other side of that view. But again, they're going to have to argue with this data I'm about to throw at them. So let's do that. So I'll start with aggregate income growth. So when you private sector employment, which we take here at 42 Macro as the mean of household sector employment and establishment survey employment, so as to not bias them to either sort of sample, we find that we use some product employment, wage growth, and hours worked, you wind up with private sector labor income. And private sector labor income is actually accelerating on a 3-month annualized basis to 5.3% in the most recent jobs report, in the August jobs report. That is an above trend pace of private sector labor income growth. No one's talking about that right now. The most recent jobs report, we have an above trend pace of private sector labor income. If you want to ignore the 3-month annualized because they're a little bit noisy, the year-over-year rate of change of private sector labor income is currently at 4.3%. It's been at or above trend every month since early 2021. So this labor market has been generating a tremendous amount of income for consumers and an at or above trend level since early 2021. And we can confirm that with a more lagging indicator that we get from the BEA at the end of the month, which is nominal employee compensation. That's what our private sector labor income metric tracks. And you can see that nominal employee compensation has been at or above trend in every month since early 2021. And, we are, accelerating in the most recent data point, which is July, and we're likely to accelerate again in August once we get the data point next week. So investors should be aware that income growth in the labor market is quite robust. When you look at it from a labor supplies perspective, we've had this massive tailwind in terms of labor supply, which serves two purposes, right? You actually can grow the economy with the incremental labor supply, but the incremental labor supply puts a depressing impact on wages, so you can grow the economy with no inflationary pressure. If anything, it's probably reducing inflationary pressure from the perspective of unit labor costs. And so that's what happens. We have this sort of positive supply side boom that we've experienced in the labor market in recent years. So right now, labor supply is slowing. It's only up 709K on a nominal basis, on a year-over-year nominal basis in August. That number was plus 3.7 million in November. And so all that additional labor supply that we continue to observe that's causing the unemployment rate to go up is actually not necessarily due to firings, layoffs, and discharges. Mm-hmm. And so the thing I would say with respect to, pushing back against the SOM rule being triggered or the unemployment rate rising, the thing that we would push back against most on that is the fact that we continue to observe a tremendous degree of labor hoarding in the U.S. economy. So in this chart, we show Joe's total job openings divided by total unemployed workers. That number has declined significantly over the past couple of years, and it's right at trend. We see private sector hires rate. That number's declined significantly over the last couple of years. It's slightly below trend at 3.8%. The private sector quits rate, that number's declined significantly over the last 2 years, and it's right slightly below trend at 2.3%. All these three metrics have historically been inversely correlated to the fourth panel here, which is the private sector layoffs and discharges rate. But it's the private sector layoffs and discharge rate. If it was doing what it historically would have done, we'd be above trend and accelerating, much like these things are below trend and accelerating lower. but that's not the case right now. So we have clear evidence that there is a labor hoarding phenomenon going on in the labor market. And we also see evidence of that between the divergence between household survey total employment and total job openings. Historically speaking, these time series have moved in lockstep with each other. But ever since 2022, we've had this divergence where we've seen slack created in the labor market through the lens of reduction in job openings, but we don't have a reduction in total labor employment. And so that's very supportive of this labor hoarding phenomenon. And it's our view that labor hoarding, what's going to stop labor hoarding from persisting? There's obviously a structural shortage of skilled labor in this country, as evidenced by the NFIB survey. Job openings hard to fill, fewer no qualified workers for job openings. Those metrics continue to be far and away the two highest index levels amongst all the, I want to say 30, 40 different sub-indices within that report. So we continue to see labor hoarding and a lack of skilled, high quality labor supply contributing to this dynamic. But another thing that's contributing to this dynamic that investors don't talk about enough is the fact that we remain in this ubiquitous corporate profit cycle upturn. Right now, we show NIPA corporate profits in the blue line of this chart and our corporate profitability model, which is a proxy for corporate margins. Both of those numbers are accelerating at above trend levels. So we have a corporate profit cycle upturn. So there's no real reason for corporations to, want to hit the button, the exit button or escape hatch on labor hoarding anytime soon. So it's our view that the labor market remains, fairly robust. It's moderating. It is creating slack, but it's not creating slack at a pace or to a level that would cause that should cause a trending risk-off market regime associated with rising recessionary fears.
What I love about what you do is that you bring the data and you bring the charts to defend your arguments. So that was just very well executed.
Do people not do that?
I mean, I'm not saying
people just get on here and talk for an hour.
Yeah, I'm just gonna say I appreciate it.
I don't think I'm smart. I'm a pretty smart dude. I'm not smart enough to talk for an hour.
Look, the last component of this whole debate that was being talked a lot about 6 to 8 months ago is the fiscal impulse, fiscal dominance. Right now, since we're in this little bit of a growth scare, there's less talk about that. Is that fiscal dominance, fiscal impulse still alive and well, or what are you seeing on that regard?
100%. Fantastic question, because that's where I was going next with this. The fiscal impulse had been modestly negative for quite a while, really since the early part of this year. If you go back and you look at, so what I'm showing in this chart is the net receipts, net outlays, and ultimately the budget balance on a fiscal year to date, year-over-year percentage change basis. So that's a mouthful, but just the percentage change on a year-over-year basis, but on a cumulative fiscal year to date basis. And so with the data through July, the budget deficit was down 6% on a fiscal year to date basis. Data through August, the budget deficit is now up 24% on a fiscal year to date basis. That's a massive, massive delta in terms of the swing from a negative fiscal impulse to a positive fiscal impulse. You can see this a little bit differently if we look at this on the calendar year to date basis. So in our fiscal policy monitor, where we track federal revenues, federal expenditures, and ultimately federal budget balance through various metrics, the change, the share, et cetera, what we find is that on a calendar year-over-year nominal change basis, the fiscal the fiscal impulse has grown to a positive plus $284 billion. So essentially, the budget deficit is $284 billion wider now on a calendar year-to-date basis through August. Through July, it was up to almost $200 billion smaller. So we essentially just had a $500 billion swing in 1 month in terms of the fiscal impulse. And that's likely, in our opinion, to contribute to the resiliency of the economy, the resiliency of the labor market, and ultimately, if we're right on our medium-term outlook for the economy, it's going to contribute to the resiliency of inflation as well. One of the reasons, we're in the camp that growth is slowing. We're in the camp that the labor market is moderating. We're in the camp that the arrows are pointing down with respect to both of those dynamics. But where we differ from consensus, which is the blue lines in these charts here, where we differ from consensus is that we expect growth to continue persistently surprising to the upside. That's been the dynamic ever since we altered our resilient U.S. economy theme. Growth has been generally and persistently surprising to the upside. In fact, consensus estimates have continued to ratchet higher throughout that entire process, and that's been one of those dynamics that's been supportive of asset markets, and we think it'll continue to be supportive of asset markets. We're probably not going to see the kind of high Sharpe ratio returns in the stock market that we've seen over the past, let's call it not really a year, almost 10 months or so, prior to this most recent correction. We're probably not going to see that kind of return in the context of a growth curve that's pointed lower, but we can have a positive resolution to this summer volatility that we saw that was associated and primarily kicked off by rising recession fears. And ultimately, we think as we move forward in time, those rising recession fears will continue to fall by the wayside as consensus estimates for growth for the U.S. economy, continue to get revised higher. So that's our general baseline expectation.
Yeah, I mean, that makes sense. And you sort of see that in the data. Like we got a few points in that came in today, like industrial production month over month was a beat. Atlanta Fed is revised up to 3%. So definitely seems that way. Like we bottomed out and starting to trend towards higher.
Yeah, well, it just in surprise terms. I mean, I don't think that
Yeah, yeah.
the growth of the economy is unlikely to trend higher from here. I mean, we're at a very asymmetrically high level. We're at 3% on a 3% in terms of GDP. It's right around a 1.5, 1.6 kind of level in terms of a 5 on a Z-score basis relative to the relative to the 2015 to 2019 sample. As a kind of proxy for what the economy used to look like. So we're in an asymmetrically high level of growth. But again, it's the path that we take down from that asymmetrically high level of growth that has the greatest implications of asset markets. It's not just the direction of travel, it's how the direction of travel correlates to investor positioning, which has gotten a little bit lighter than it had been in recent months. When we made the call for our clients back in late June to take down risk, the positioning cycle was beat red. In fact, even at the year-to-date highs in the market, the positioning cycle was beat red. So one of the things we do for our clients, we do everything we do for our clients daily, 6 times a week here at 42 Macro. So you're going to see a lot. Our clients see a lot of the same charts, same models, same analysis, but that's what institutional investors do. We Bayesianly observe things and respond to the changes. And so one of the things that we observed at the year-to-date highs in the stock market that caused us to send out a signal to our clients, hey, there's a high probability of a correction in risk assets over the short to medium term, which is we had things like the AI Bulls Bear Spread and the National Association of Active Investment Managers stock allocation survey. Those things were like in the 90th plus percentile, 98 type percentile type levels, at the year-to-date highs in the stock market. So that gave us an indication that, okay, we are at the top of the sine curve in growth. Investors aren't even talking about the rate of change of the slowdown yet. We're probably going to have a period of choppiness of volatility associated with figuring that stuff out. But I think we're getting closer to the end of that period of choppiness and that volatility. And if they were correct on that, they were talking about a year-end performance chase in the institutional investor space that could easily spill over into the first part of next year, because we're talking about a debt ceiling issue where we could see a significant drawdown in the TGA.
What's up, everybody? Just want to take a second out of the show to talk about the next major Blockworks conference that's happening. Permissionless 3 is a leading crypto conference, and it's going to be happening in Salt Lake City this year from October 9th to 11th. There's going to be some major legendary speakers there from the likes of Balaji, Chris Dixon, and macro veterans like Dan Teffiaro will also be there. Not only that, but we're also going to be doing a live recording of the weekly Roundup Guys Emporium edition. So you can come meet myself and Tyler and Quinn, and even Mike will be there. If you're interested, we have a discount code FG10. Use that and you'll get 10% off as well. So I hope to see you there and that we can catch up. All right, back to the show. Okay, so I want to shift gears a little bit to what's going on with the rest of the global central banks. And I want to frame it around what's been going on with the unwind of the yen carry trade and just rate differentials through different global markets. So there's concern right now that if we see a 50 bips cut tomorrow, that's going to add to further strength on the yen side of things, because the Federal Reserve is net easing, net dovish, whilst the Bank of Japan is arguably net hawkish and increasing rates. That's going to lead to further strain in rate differentials and show strain in currencies. So what are you looking at in the rest of the world? And what's your perspective on these potential strains of, if the Fed eases more than expected, it's going to actually be, potentially bearish because of these rate differential stresses?
Yeah, I think it's more of a combination of the two things. So the markets didn't start crashing, and go back to early August. The markets didn't start crashing until we had the jobs report. The Bank of Japan hiked their interest rate on Wednesday. On the Wednesday before, and we didn't have the issues in asset markets until Friday. So to me, what I think is in the driver's seat is the U.S. business cycle dynamics. Is the U.S. economy going into recession? Because ultimately, if the U.S. economy goes into recession, then there's a tremendous, I can't understate this enough, the world's scariest dam crack ever. Think about the biggest dam in the world. So I think it's probably in China somewhere, if I had to guess. Think about the biggest dam in the world with a giant crack in it. That's exactly what we're trying to talk about. That's the kind of risk we see in asset markets if the U.S. economy goes into recession, because there's a tremendous amount of, sort of capital here that was sort of escaping the sluggish world in the post-pandemic economy across Europe, across China, across Japan. This was the only place in the world that was growing, primarily due to our very aggressive response in fiscal monetary terms to the pandemic. So I'll show that chart here where we show the U.S.'s net international investment position. So these numbers, charts don't do it justice. We doubled our net international investment deficit in the 5 years through 2023. We went from minus $10 trillion in 2018 to minus $20 trillion in December of 2023. So that means foreign creditors, foreign capital allocators now own $10 trillion more US assets than they did in 2018. So it's a double. It's a double relative to where they were in 2018. So that's a tremendous amount of unrealized capital gains that could flow out if global capital allocators get really nervous about the duration and sustainability of the US business cycle. So to me, it's not necessarily what Japan does in isolation. It's what Japan does in the context of what's happening in the US business cycle. So, we are of the view that we're probably going to see more policy normalization by the Bank of Japan than what's currently priced in to JPY money markets. If you could currently look at this chart here, we just show baseline Taylor rule spreads, relative to the 12-month bill yields in each of these economies. So you got the Fed here, got the ECB, you got the Bank of England, Bank of Japan, and the Swiss National Bank. If you look at the Bank of Japan, right now the markets are essentially saying, okay, the 12-month T-bill yield in Japan is 367 basis points lower than what the Taylor rule estimate suggests it should be. So that's essentially saying the markets are essentially saying, the markets are essentially saying, okay, the Bank of Japan, you're way too easy relative to the current dynamics that we're observing in the Japanese economy. And as a function of that, the JPY money markets are currently pricing in, if you look at overnight index swaps, pricing in essentially 1/4 point rate hike between now and the next calendar year. That number is probably too low, in our opinion. If you look at some of the dynamics we're observing in the Japanese labor market, because that's been Ueda's North Star, Bank of Japan Governor Kazuo Ueda has been very much anchored on wage dynamics of the Japanese economy as their North Star for monetary policy normalization. At 3.6% on a year-over-year basis, nominal wage growth in Japan that's the third highest monthly year-over-year rate of change growth print we've seen since 1997 in Japan. So if you look at it on a scheduled basis, so these are your actual, contracted earnings, they were actually accelerated to 3% year over year. That's the fastest rate we've seen ever in the time series. So we believe that Japan, the market is too sanguine with respect to the medium-term outlook for Japanese policy normalization. That's going to cause big problems in unwind terms, in Japanese yen carry trade unwind terms, if we, 42 Macro, is wrong on the medium-term outlook for U.S. growth. If you're wrong in the U.S. medium-term outlook for U.S. growth, and the soft landing, if going back to that bimodal distribution, if the soft landing mode goes down and we actually add share to the hard landing node, then we ultimately means that we're going to see this $10 trillion, some significant share of that additional $10 trillion of foreign capital to unwind. And this is what happened in the dot-com bubble. You didn't have to have a significant recession. In fact, the recession in 2001 was the shallowest recession in U.S. history. It was only 30 basis points peak to trough in GDP. But what happened was a significant drawdown in asset markets because you had a significant fund flow dynamic that reversed. And we also saw a significant bear market in the dollar from that point as well. So I want investors to be well aware of these dynamics that, there is a real tightrope that investors need to walk over the next year. So I still think we're cautiously optimistic on risk. We think if we're right on all of our views, risk assets should be higher a year from now. The bond market's probably peaked out already. The dollar should be lower a year from now. And so if we're right on all those views, then that's our base case scenario. Where we could be wrong is if we're wrong on growth, then we're going to have a significant drawdown in asset markets associated with not just Japanese yen carry trades unwinding, global carry trades unwinding. Don't forget the Europeans are big capital allocators too. If you look about who allocates capital globally, look at the net international investment positions of Japan, of China, of Germany. They're all kind of in the $3 trillion range. If you look at Hong Kong, it's kind of in the $2 trillion range. These countries have flowed a tremendous amount of money into our economies, or into the U.S. economy and U.S. asset markets in recent years. And ultimately, that money's got to come out if the kind of U.S. growth outperformance and just the general sustainability of the business cycle kind of unwinds.
Nice. Okay, so that makes sense. When I hear you talk about surprise hawkishness from Bank of Japan, that's concerning. But if we're going to see, this recession not actually occur in the U.S. and growth rate accelerate higher, even though that might be less net easing from the Fed, it might not be a necessarily bad thing for risk because it's going to allow that strain to be less intense. Is that how you're seeing it, basically?
100%. So you got to start with the first principles. Does the economy need easing? I would say it doesn't need easing, but it probably can take some easing, right? There are obviously low-income consumers and small businesses that are primarily exposed to the level of the policy rate that are ultimately, feeling the pinch right now. and they could probably use some easing to kind of stave off a further retrenchment in their spending and investment activity. However, the broader economy, if you think about this from a sort of aggregated basis, does not. If we think about the rich consumers, the high income consumers, and large companies and medium sized companies that have access to capital markets, they're already benefiting from the tremendous amount, the 10 rate cuts that are currently priced into the money markets and the bond market. The mortgage rates are already lower if you need a new mortgage. So the U.S. economy is hyper financialized. I got a very important chart to show on that particular subject. The U.S. economy, 33% of all private non-financial sector debt in the U.S. economy is on bank balance sheet. And so the obvious conclusion is what I didn't say, which is the other 70% is generated by the capital markets. And so if you are a borrower that relies on bank funding for your business consumption and investments, then you are feeling the pinch of the 5.5% policy rate. But if you're in the other 70% of the private non-financial sector debt that's out there in the U.S. economy, you are high-fiving because the 10 years at 3.35. You're high-fiving because we've priced in a tremendous amount of rate cuts already into the forward rate curve. You're high-fiving because equity valuations are high. The U.S. is a have versus have-not economy. It's an incredibly have versus have-not economy. If you look at the share of consumer spending by income cohorts, the lower third of households by income only account for 15% of consumer spending. The upper third accounts for 51% of consumer spending, the actual inverse. Now, that doesn't make any sense. That's obviously not a stated policy objective, but it is what it is. And you need to understand these dynamics if you're going to be right about the U.S. growth and the U.S. business cycle and ultimately asset markets. And so, fortuitously, our clients have benefited from this for the past couple of years.
Want to finish up this conversation on global central banks by talking about China. When we look at commodities, they're on the floor these days. People are attributing a lot of that to what we're seeing come out of China. What are you seeing on the Chinese economy and what's going on over there?
Yeah, 100%. So I'll start with our China grid model, our Chinese growth. So we maintain that same grid model process for every major economy in the world. So not just U.S. Obviously the U.S. tends to dominate the market regime that we need to respect and position for as investors. But China, we look at where China is, we have Chinese growth continuing to moderate over the medium term. So ultimately that means the pressure is going to continue to be higher and higher on the PBOC and on Beijing to implement more dovish policy. In fact, I would argue we've been very disappointed by the pace and scope of policy stimulus that we've gotten out of China. And quite frankly,
it's been very little, it seems like.
It's been very little relative to what it should have been in the context of this chart here. So the Chinese property market is deflating is probably a very kind word. It's probably, I would say, crashing. If you look at total sales of buildings, they're down 24% on a calendar year-to-date basis. Total supply of new building construction is down 10% on a calendar year-to-date basis. If you look at nationwide home price appreciation, down 5% on a year-over-year basis. That's one of the lowest growth rates we've ever seen. If you look at it in existing homes, it's down 8%. That is the lowest, deepest contraction we've ever seen in China. So that's a big deal because this property market is about 25 to 30% of Chinese GDP. So if they can't get this, kickstarted and going in the other direction, then we're going to have a significant problem in the Chinese asset markets because ultimately we all know that China's got a debt problem. You got to at least try to grow your way out of the debt. If you don't try to grow your way out of the debt, then the debt's just going to fall on top of your head and consume you. You might as well go out with a fight, And so at 200% of GDP in terms of private non-financial sector debt to GDP in China, we're, basically at levels that were only consistent with Japan prior to its structural debt deflation, in the late 80s, early 90s. And so this is the kind of long-term, structural risk that we've identified in China going back to February of last year. We said they were reopened into a structural liquidity trap. I think we were very right on that. We've seen Chinese asset markets and Chinese economy do nothing but go down since then. So I think that was quite a prescient call there. And so it's been our view since December of last year that they would start to do something about that to counteract that. They did a little bit going back to late last year where they accelerated the PBOC's balance sheet. That's the blue line in this chart. But then they've since kind of pulled back and they're only now just ever so slightly getting back involved in terms of engineering stimulus into the Chinese economy. We think that's going to accelerate in the coming months for a variety of reasons, not the least of which we continue to get both activity and property market data to support this view that says they need to hurry up and go. But we also are now kind of at the precipice of a Fed rate cutting cycle, which should take some pressure off of the PBOC and off of Beijing with respect to stimulating the Chinese economy through the lens of a weak dollar. And if we get a weak dollar, then that's obviously going to be quite supportive of the Chinese guy. It's going to be quite supportive of the global economy if a weak dollar comes in the context of a relatively sanguine U.S. Economic environment.
Yeah, I was going to ask you why you thought they weren't stimulating, and my feeling was that potentially they were waiting for the Fed to start to ease. Sounds like that's what you think is one of the large factors.
Yeah, it certainly has become a very large factor in our opinion. Yeah, I would suggest that there's a social dynamic as well. President Xi understands the debt situation, and so his natural inclination is, based on his own, his own personal history. Austerity is sort of his way to deal with it, but it's historically speaking, you're not going to austerity your way out of a debt situation. It is what it is. Debt only goes one way.
Yeah.
Until we have a debt jubilee, it only goes one way. If you try to go the other way, you're gonna find out the hard way exactly what happens when it goes the other way.
Well, with respect to everything we've talked about, I want to hear and just wrap this up around asset allocation. I know you have quite a systematic approach, but with respect to that, we'd just love to hear about how all these different views you have get evaluated and shown into your asset allocation approach and exposures there.
100%, my friend, 100%. So, as you know, I'm glad you said that, Felix, because everything we just spent 45 minutes talking.
Mm-hmm.
0% of those words has anything to do with what we're telling our clients to do in their portfolio. Zero of those, 2,000, 5,000 words we just spoke has nothing to do, because that's not what institutional investors do. That's not what the best investors in the world do. The best investors in the world don't just put on and take off positions because they wake up and feel differently about growth or differently about inflation. There's a systematic, sort of risk management system saying, okay, I need to stop doing more of this, or I need to do more of that. And so that's exactly what we're trying to do here at 42 Macro at all times for our clients. The number one thing we do well, and why our clients typically outperform the average investor, both on the buy side and also retail, is because we help them identify and position for the market regime. We don't help them identify and position for where growth is going, or where inflation is going, or where policy is going to go. We help them identify and position for the market regime. And that is the most important, in my opinion, and not just our opinion, the opinion of many of the world's most famous investors. That's the way you make money. This is what Druckenmiller is doing. This is what Paul Tudor Jones is doing. Be more like them. Don't be more like people telling you there's a recession coming around the corner.
Yeah, Druckenmiller's not just logging on Twitter and saying, "Oh crap, now I gotta buy bonds because of X reason," and just decides to do that. There's a whole process.
There's a whole process, and the process starts with understanding what markets are trying to price in and participating in that. If you don't want to participate, you can step to the side, but certainly don't fight it. If you do not fight what markets are trying to participate in. Just if you have a different view of what the market's trying to price in than if that view is different than your view, then just don't participate. The best thing you can do is don't participate. The worst thing you can do is say, I'm going to fight the market, which is what most investors do. Most investors want to be right. They don't want to make money. They want to be right. And those are two very, very different things. And I think you really I heard your smirk. That tells me you know exactly what I'm talking about.
100%.
Exactly. So everything we've talked about, up until this point has been helping the listener prepare for market regime change, understand how the market regime is likely to evolve in the future, so that when it does evolve, you have the confidence and you do not have the emotional baggage associated with the legacy positioning and the legacy regime. You can just dispassionately say, okay, we are going from, inflation to reflation. So I need to do this, that, I need to do that, or I need to do that. Or we're going from deflation to Goldilocks. I need to do, less of this. I need to do less of that. I need to do less of that. I need to do less of that. I need to do this, and this, and that. That's it. That's all we're doing here at 42 Macro is trying to help clients prepare for regime change. But at the end of the day, in terms of everything we say or do that actually impacts their portfolio, it's going to be through the lens of identifying and positioning for the market regime. So the best way we do that for the retail investor audience is through the lens of our KISS portfolio construction process. And so that process is a 60-30-10 trend following strategy that is designed specifically to demonstrably outperform 60-40. And how it does that is through three core tenets: factor selection, infusing Bitcoin into the strategy. That's the 10. Top-down risk management overlay, infusing vol targeting into the strategy through the lens of our market regime nowcasting process. And then our bottom-up risk management overlay, incorporating dynamic position sizing into that process through the lens of our 60-30-10 trend following strategy. Like, why do we do what we do? Well, because it works. If you look at our VAM signal for stocks or for crypto, you have a 96% upside capture ratio in the stock market, a 98% upside capture ratio in Bitcoin. If all you did was just long those assets when our VAM signal said be long those assets. If you look at it from a market regime nowcasting process, which is again is the process that we use to incorporate volatility targeting into that KISS portfolio construction strategy, you have a 97% upside capture ratio in the stock market and 109% upside capture ratio in Bitcoin. which means our market regime nowcasting process is actually better at trading Bitcoin than Bitcoin is at trading itself. How about that? So going back to our portfolio construction process, I'll wrap it up after this one final comment is this stuff works. If you look at KISS, it has on an out of sample basis, it has an average annual return of plus 16%, which compares very favorably to the average annual return of 60/40 of plus 10%. It does that with far superior drawdown and volatility characteristics. The max drawdown of KISS in this throughout the duration of this out of sample back test, which begins in January 2018, we launched KISS in January 2023. There's only one double-digit drawdown, and it's minus 12%. The max drawdown for 60/40 is minus 22%, and oh, by the way, that's actually occurred twice. If you wanted to run 60/30/10 SPY-AG and Bitcoin without our top-down and bottom-up risk management overlays to sort of help you maximize upside capture in bull markets and minimize downside capture in bear markets, then you'd have a max drawdown of minus 26%. And oh, by the way, you would crash 3 times since January of 2018 in your overall portfolio if you did not have the benefit of these overlays. And so I'll wrap it up by just kind of indicating where we are currently with KISS. Where we are currently with KISS is incongruent with everything we've talked about thus far with respect to our sanguine outlook for risk assets and our modestly, negative outlook for fixed income for the bond market. Right now, we're at 40% of our maximum exposure of 100% of 100% in cash. We're only at 50% of our maximum exposure of 60% in stocks. We're at 100% of our max exposure of 30% in fixed income, and we're at 0% of our maximum exposure of 10% in Bitcoin. So if we're right on those fundamental views, then the systematic processes vis-a-vis the top-down and bottom-up risk management overlays featured in KISS are going to guide the trend following process higher in stocks and Bitcoin and guide the trend following process lower in asset allocation terms into the fixed income market. So that's what I'm expecting to do. That's what we're coaching our clients to expect to happen. And if we're wrong on that, then guess what? KISS is going to do a hell of a job like it always does with managing risk, because again, where most investors have the biggest problems in their portfolios, it's not as a function of trends not, determining themselves and persisting. Where most investors have problems in their portfolios is anticipating trend change. That does not happen. It's always better, and I'll shut up and end on this. It's always better. Let me look at the camera. If you're an investor, it is always better to be the second investor in a confirmed trade than the first investor in a trade that never gets confirmed. Just think about that. Most investors spend all their time trying to forecast new trades. But what we do here at 42 Macro that's very different than that is we respect the trend. And more importantly, we have very sophisticated quantitative tools that buy-side investors are relying on to help them identify trend change early so that we can get in the new trend faster than everyone else gets in the new trend. And more importantly, get out of the trend faster than everyone else gets out of the trend. That's exactly what we do, and we're really proud of it.
Awesome. Yeah. That mirrors so much about what you mentioned earlier about, do you want to be right or do you want to make money? And, you don't need to be jumping in for the hero trade. You just need to be able to ride the wave and do that in a systematic manner where, your own heuristics don't get in front of you.
But we can do a whole hour on heuristics, but I think we're kind of pushing up on time here. So Felix, man, this has been fantastic. I really appreciate the opportunity to join you guys today.
Yeah, likewise. I really enjoyed that, and always great to hear from you. And yeah, we'll see what happens tomorrow.
Let's do it, my friend. I'll see you, brother.
All right. Have a good day.
You too.